Welcome back to Mining Stock Daily. Ian Wagner here with a corporate update from Atlas Salt, a salt developer in Newfoundland. They trade on the TSX Venture under the symbol SALT with a market cap of about $103 million Canadian. And for anyone new to this story, we spoke with Atlas Salt in November, so I would encourage you to go back and listen to that introductory episode. And I should also state that I am a shareholder of Atlas Salt, so I am a bit biased about the company and their projects. But with us today is CEO Mr. Nolan Peterson. Nolan, good to see you, and welcome back to the podcast.
Good to see you, Ian, as well. And full disclosure, I am also a shareholder.
Well, I would hope so. All right. Let's jump into it. Great Atlantic Salt Project, newest large scale salt mine in 25 years, great geology, picture perfect access to deep water port there in St. George and really solid economics. I think a 25-year mine life. After tax NPV, $920 million Canadian. After tax IRR, 21%. You guys have de-risked this thing, right? You've done the feasibility study, but there's that big CapEx number, right? That $600 million Canadian to build it. So you guys are in the process of securing financing. So my first question really is just, how is that going? And any color or kind of updates you can provide there?
Yeah, I would say, first of all, top line answer, it's going very well. One thing I want to point out is it is 600 million. It does seem daunting, but the first thing to remember is it's not all day one, right? It's not even all year one. It's over a 4-year build timeline, and it follows a typical mining company S-curve development path. So it starts low, it peaks in the middle years, and then it flattens out again. So last we spoke in November, right around the time we published the amended technical report for not amended, the technical report for our updated feasibility study, the 43101. That allowed us to complete a whole amount of whole scale due diligence for our lenders, the prospective lenders that we are planning to finance this project with. I've mentioned this before that we've been working with a group called Endeavor Financial, very experienced in the mining industry and putting together financing packages. And our primary source of capital will be 60% from what are called senior secured lenders. So in this case, as opposed to a traditional mining project, we view that as very high quality debt, right? The type of lending that normally a mining company that's pre-production can't attract. Sovereign wealth funds, export credit agencies, major commercial and infrastructure banks. So they require a significant amount of due diligence. And to centralize that, we engage third-party groups to provide that due diligence in one source instead of them all doing it independently and asking us to pay for it to take a look at the project. We pay for it one time. The updated feasibility study allowed us to complete that, allowed us to move forward with site visits with an updated feasibility plan. That has been all completed over the past few months. And as of this week, as of today, actually, when we're recording this, we have gone to market, and by that I mean sent out all the due diligence information to the parties that have expressed interest in the financing. So the process is moving along as we planned. It's going quite well. The market is very receptive. We have a significant amount of interest. We've already received LOIs for the financing that we announced last July. So yeah, things are going well. Sorry for the long-winded answer there, Ian, but
No, that's
yeah.
that's great. I mean, that is a great top line answer. And one of my follow-ups was going to be that debt component. And if you're still targeting that 60%, level,
Mhm.
is that still the number you kind of have in mind, or how is what when you have those conversations with Endeavor, does that seem, realistic, and kind of what's the
Yeah,
takeaway there?
yeah, very realistic. And so remember, if we take a look at uh 600 million and we say take 60% of that, as a target 360 million, we've already got a funding commitment from Sandvik, our equipment provider, for at least 100 million or so in financing. and that's for their equipment. So that is already of that 360 million. We've already got a huge chunk of that locked in as well. In principle, of course, we got to finalize all that, and then we layer on the rest. So yeah, it's looking very good. I will say to kind of answer beyond your question is there is the opportunity for even more debt, but subordinate debt, not unsecured lending, higher interest rates, right? Different terms. But this is the type of debt sometimes you see as the top debt on a mining project because they are more volatile. They all are riskier, but for us, they would be down in our capital stack. So we see the opportunity to layer on additional debt once the senior secured is lined up. And we have seen that interest come in over the past few months as well from other groups that say, hey, once you've got the main package figured out, come talk to us and maybe we could be good for another 5, 10, 15, 20%. So yeah, it is. That's why I say it's looking very good on the financing front.
Yeah, and then just to put that kind of in helpful terms for investors too, like that's just going to decrease that overall level of dilution, right? That would be needed, or that when you go to raise that equity, and also assuming, right? You're you know taking off thinking about a significant re-rating after that debt comes in, and then financing an equity raise at those higher levels.
Correct.
Is that correct?
Yeah, correct. We can't plan for that, of course, but as we've seen in other projects, that's certainly in the cards. And I will remind people as well, there's a lot of opportunity, especially in the market these days for government funding through various different channels, right? Just 2 days ago, the Prime Minister announced a new sovereign wealth fund that can support these types of nation building infrastructure projects that we could see ourselves easily falling into. Of course, it's early stages on that. I'm sure the government themselves don't have a full understanding of what that's going to look like, but we would certainly be at the forefront of trying to access that type of capital as well.
Yeah, that's a good point. Because there's so much attention on critical minerals right now, and a bunch of commodities that sort of don't fit in the precious metals, base metals. Where does salt fit into that sort of country specific strategy of sourcing or maintaining that material? Does salt fall under those lists of certain things that might be able to receive either just government support, I guess?
It doesn't well, it depends. So we are not at this point in time listed as a critical mineral. We certainly feel that we could be or and slash should be, and we would work towards making that a reality. There are other lists, green type projects, infrastructure type projects, export focused type projects, job creation type projects that are also available for funding, and we are accessing those are working to access those types of funds. So yeah, where we think we fit is very nicely into the message that the government, federal and provincial governments, are trying to build and trying to get across to Canadians. We have a project here that is a job creator. It's a generational wealth creator, right? We have a 25-year mine life plus an additional 50 years potentially in resource, plus everything's that's open to the extents that we expect to find more salt as well if we were to drill once we're in operation. There's no significant opposition. As you mentioned, we've de-risked it. We've got an environmental assessment approval. We've started construction activities. The list goes on and on and on. It's an export product. It's also a product that we need once we've satisfied our domestic needs. We have a strong export market for it. So yeah, it fits very nicely in there. Now the issue for us, of course, is there's not 10 other salt companies also saying the same message to the people that are listening. So we're kind of out there ourselves pushing it, but a strong argument always wins the day, and we're making it.
One more question around the financing. Are you thinking about offtake agreements? Do debt investors want to see offtake agreements? Like how do those fit in, or do you want to go kind of unhedged into the market after construction begins?
Yeah, the lenders want to see some sort of certainty that there is a market for the salt. uh, although it's pretty clear that there is, especially we saw what happened this year and this winter and last winter, salt shortages in North America, and certainly with the disruptions to global trade that we've seen in the last couple of weeks, or last couple months, sorry, the price of fuel going up, that is limiting or increasing the cost of imported salt into the domestic market. So we feel very strongly there's a good market, and you can easily move in unhedged when you're the lowest cost producer in your competitive environment, which we would be expected to be. But again, the lenders are pushing for some sort of cost, some sort of sales volume certainty that they're going to get paid back. I completely understand that. We have a partner, Scottwood Industries, which we have an MOU with right now. It was signed under the original feasibility study numbers. We're looking to expand that for the updated study number. Um, but yeah, to answer your question, yes, it is something that is at the forefront. We have to do what's best for the company, though. We can't commit to anything too early that's not favorable to what we can't lock in a low price today if it harms us in the future. So we have a balancing act to work towards, which we're doing quite well on.
Right. Okay. And then I'm glad you brought up Scottwood because I was going to ask because I remember seeing that in I think a 2024 non-binding MOU, and it was
Yeah,
for I think 1.25, 1.5 million tons per annum, which would be I think around a third of that 4 tons per
yeah.
annum you guys have been targeting. Is how do those how have those numbers changed, or how are you thinking about that now?
Yeah. So that was 60% of the original feasibility study number, and we've of course improved the production from the original to the updated. So we are still in active discussions with Scottwood to expand that number. There's every indication that they want as much salt as possible, and yeah, it's just evolving that document to the type of structure that the lenders want to see. But yeah, very positive relationship with Scottwood, and they are very optimistic about the project as well.
Stepping back to the market for salt, and one of the interesting components about your guys industry and project is that salt is much more of a stable commodity than say gold or silver, right? I think the feasibility study base case was around that $81, 81 and a half. This past winter we saw spot prices in Ontario kind of hit I think close to $200 a ton. I mean, you can provide some numbers if I'm wrong, but how are you, yeah, anchoring your sort of conversations to are you still anchoring them to that base price, or how do you sort of retain any upside exposure, or where do you think, um, the price might go?
Yeah, I think that the best way to approach it is to make sure that we have for the lender's needs on an offtake agreement, that we have some certainty or that we give them certainty that they're going to get paid back, right? So we cover their cost of debt, cover our operating costs and things of that nature, and then leave anything beyond that to kind of negotiations with the counterparties that are out there. And so, yeah, it's we want to be sensitive to being able to capture some of the spot price increases that we see while understanding that even as you mentioned, the spot price was close to $200 in Ontario, still about 60 to 70% of salt is sold in North America under 1-year government contracts, so they're kind of insulated. Now, those spot prices do impact next year's prices, which are being set really in the spring, summer, so around this time frame. It's very complicated, very fascinating. We won't get into it in detail here, but yeah, it is something that we are balancing first to make sure that the lenders get certainty that we can move the amount of product that we are planning to make, that we can move it profitably, that they can get paid back. And then the other side, of course, is to maximizing the return for the equity investors, which, you know, the prices that we've seen over the last year or last couple years have already exceeded our feasibility study numbers. People probably don't understand this, but our feasibility study numbers were generated in the summer of 2025, right? And so they would have had partial information for the 2025 uh, bid season. So largely, a lot of our numbers were based on the 2024 bid season. And for people who are following the salt industry, they'll know then that they don't fully bake in the prices we've seen in the 2024-2025 winter, nor the 2025-2026 winter that we just saw. So the prices that we've used are actually probably conservative to what the actual market price is today. And that's something to keep in mind. But again, we're getting very complicated. A lot of intricacies here. We unfortunately can't just go to the London Metals Exchange and pull a price off of there and use it. But rest assured for your listeners that we are doing a lot of work to understand and maximize the salt price that we achieve.
Yeah, I think just to to put a button on that, we don't need to get too granular, but it's that dynamic, right? The tension between wanting as much debt as you can, which means you have to offtake it, but also wanting to retain exposure to the higher price environment, right? Should that continue or should that come? I guess turning a little bit now to valuation and you've talked a little bit about how you think the project and the company could or should be valued. Kind of when Great Atlantic, will generate stable, recurring free cash flow from governments and municipalities who are legally obligated to buy salt, that makes it more or could make it more like a coupon or annuity than say like a volatile commodity play. So instead of valuing it like a PNAV, maybe like a typical junior miner that our audience, invests in. You've argued, or at least they should consider a free cash flow yield approach, the way fixed income instruments or infrastructure assets are priced. Can you just kind of expand on that for maybe just because I don't know that people think about that in their regular investing course if they're in the commodity space?
Yeah. Yeah, the commodity space, of course, is dominated by the 43-101 that requires you to prepare an NPV, discounted cash flow. Very, very good way of valuing a project. Largely captures all of the cash flows of a project and discounts it to today to provide a present value. So we have done the same on our project, but because of its long-lived nature, 25 years in reserve already, the discount rate of 8% is excessively punishing on later years of operation. So pretty much everything beyond 15 years gets discounted to where it's essentially meaningless. And then when you factor in our resource estimate, which could be added to the deposit, and could end up being make it into reserve in the future. And I'm using my words carefully here. Could, but more likely will, but no guarantees. All of that is essentially valued at zero as well. A typical gold project is 10 years out of the gate when it's first built, right? So all of its prime, all of its cash flows are in a very high, very low discounted period. So they have very high NPVs, which is, of course, what everybody's looking for. Cash today is valuable, but then they don't suffer any loss of value on years that are outside of the reserve because there aren't any. So that's why I would say, you have to take a dual approach here. Certainly look at the NPV, see that we are, as we stack up with other resource sector plays, or sorry, industrial minerals sector projects, we're very attractive, close to a billion in NPV at 21.3% post-tax IRR. Typical industrial minerals are sitting at about 15%, right? 15 to 20% is good. So we're already very good beyond that. And then consider that extra cash flow valuation. And this is not abnormal, right? Many industries are valued based on forward sales or cash flows, or for some that are like tech industry, certainly they're valued on hopes and dreams in many cases, right? AI, for example. Another thing to consider with a typical resource sector project, and many of your investors who've invested in producers will realize this, is a company will spend a lot of money, build a project, and then they're basically the first few years are paying back the mine that was just built. Then they get a few years of production, and then they're facing a shutdown because the mine life is going to end in 5, 10 years, and they have to find the next mine. So there's a replenishment capital cost that's not built into that mine's plan, right? So a lot of that cash is going to be used to find the next mine. Otherwise, the company you're invested in is just going to wither away. So that is not captured in those projects. For us, you don't have that risk because as we mine 1 year, we're adding in a year that is at the end of the mine that was getting that low discount rate. It's being added. So you're kind of not even losing any NAV as you go through the mine plan, as opposed to a gold project where every year you mine, that NAV of that project drops markedly.
It's a good way to think about just about the valuation and where it could be. So one quick follow up there on your reserves. You know, I don't know if this is a technical or a legal question, but how do you add those reserves? Is that something you guys have to drill out once you start mining? Is that something you guys are working on now, or can that only happen when you've mined X amount of salt? Like how should people understand that?
Yeah, so we got 25 years of reserve. To add to it, we follow the same procedure as any other mining company. You have to define it to a resource level and then run it through a pre-feas or feasibility study level. So we don't have sufficient drilling of the resource to allow us to put it into a reserve quality mine plan. It would, but I will note that based on that the 43101 mineral resource estimate standards are really set up for gold and precious metals type projects, right? Drill definition and
Mhm.
spacing for types of nuggety type deposits. They're not really set up for salt deposits, which are for the most part homogeneous. They're large scale, they're quite expansive. So for us to be the only salt mine of our nature, salt deposit of our nature globally that doesn't we would have to behave uh, in a way that no other salt mine does, right? For us to not say with confidence that our resource will eventually could potentially make it into a reserve. Now, the actual legal process to do that would require drilling at this point. It's risky to drill a salt mine more than you need to because every time you disturb the salt deposit, you're creating a channel for water to enter, which in
Mm.
water and salt don't actually go together too well, but not well and not well for
Not what you
economic
want.
purposes. Yeah. So the best way is once we're in operations to actually just continue to mine into that resource until you find that it's not actually economic anymore. And yeah, so really our mine may end up going more horizontal than vertical as we build it when we are actually mining. The other alternative, of course, is to start drilling horizontally from underground, and then you're inside the salt body at that point in time. Fascinating technical questions. Happy to answer them in much more detail to any of your investors who want to reach out. But yeah, I'll leave it there.
Okay. Yeah. Yeah. Fair. Good idea. Okay. Just a couple quick more. What are you able to do on the ground right now, kind of ahead of that financing decision? What do those sort of site prep activities look like?
Yeah, so we did start some site preparation activities. We cleared the land of every shrub and tree over, I think was 25 centimeters or something like that. And now we can do some subgrade preparation. This is all meaningful work that needs to be done. It's time consuming work that if we can pull it out of or pull it forward, decompresses the schedule, right? I don't want $50 million of work being held up because I didn't do $100,000 site preparation program that takes a month, right? So we're getting that stuff as much out of the way as much as possible right now, and yeah, it's very good. It sends a good message as well in the local community and to the government and to the investment community that this is a project that's actually going ahead, and we're very proud of that.
And last one, just on, how do you keep this story fresh, to the market while waiting that financing, because this isn't a traditional gold silver mine. There's not drill results per se, like we talked about, no M&A. Just kind of how do you drive awareness or how do you keep this communication up with the market?
Yeah, well, I need to talk to my wife. I've certainly been out on the road a lot. The best way for us to do that is just to make sure that every opportunity we can, we're telling the market about this undervalued asset that has a significant amount of fundamental work done on it already. It's like, why wait for the catalyst that may not come on some project that you've been following for a number of years when you can invest in a company that is not getting the value right now, but will once the market wakes up to it? I think that that's kind of the message. I know it's not always the most successfully received message in the market, but that's really what we're pushing. And we've got a lot of stuff we're working on. It may come in a deluge at some point, it may come over time. But rest assured, there's a lot going on that is going to catalyze and generate value for shareholders in the near future.
Excellent. Well, if investors want to learn more or have those questions or want to get nitty-gritty on, salt drilling, where should they go and what should they do?
Yeah, so you can always reach us at our website, www.atlassalt.com, all one word, two S's in the middle there, or try to reach out to me. I'm also quite active on the CEO.ca boards. You can message me directly there, set up calls. I speak to retail investors, institutional investors, the banking community, everyone who wants to hear. I'm the number one salt fan, so I like to tell everyone else about it. Yeah, and I'm sure they can reach out to you and you can put us in touch as well.
Yep, absolutely. Well, listen, Nolan, thank you so much for coming by and giving everyone an update, and just appreciate talking with you.
Thank you, Ian. Pleasure as always.
That was Nolan Peterson, CEO of Atlas Salt. They trade on the TSX Venture under the symbol SALT. The information presented should not be considered investment advice. Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decisions.